All right, let's dive into one of the most essential concepts in Canadian business tax, capital cost allowance, or CCA, as you'll almost always hear it called. In this explainer, we're going to break down exactly how this system allows businesses to account for the depreciation of their long-term assets, effectively turning not wear and tear into a valuable tax deduction. Just a quick note before we begin, the materials for our session today were prepared by Dr. Samir Al-Rishni with assistance from AI Support. Okay, with that out of the way, let's get started. So here's a quick look at our roadmap. We'll kick things off with the big question, what exactly is CCA? Then we'll walk through how it applies to all sorts of different asset categories. We're talking everything from buildings and vehicles to software and intangible assets. And to finish, we'll look at some powerful enhanced rates that are really changing the game for businesses right now. So what are we really talking about here? Well, think of it like this. When a business buys a major asset, let's say a new building or a big piece of machinery, it can't just deduct that entire cost in the year of purchase. Instead, the tax system uses CCA to let the business deduct a portion of that cost each year. This reflects the asset's gradual loss of value. It's basically the tax world's version of depreciation. Let's begin with one of the largest assets most businesses will ever own, buildings. Now, for tax purposes, these generally fall under what's known as Class 1. But as you're about to see, it's not quite that simple. There's more to it than just a single category. Okay, so what you'll notice is that Class 1 is actually subdivided. The default rate for most buildings is 4%, but to encourage commercial and industrial investment, the government introduced higher rates. So, for non-residential buildings bought after March 18, 2007, the rate gets a nice bump to 6%. And for buildings used mainly for manufacturing and processing, that rate is an even more generous 10%. Now, of course, to get access to these higher rates, there are a few key rules you have to follow. First, the building must be almost exclusively used for that specific purpose. That's the 90% rule. Second, and this is absolutely critical, a business has to formally elect to put the building in its own separate CCA class. This is so its value isn't diluted in a pool with other 4% buildings. Oh, and a quick note for real estate investors, any single rental property that costs more than $50,000 also needs its own separate class. Next up, let's talk about the assets that keep a business running day to day, what I like to call the workhorses. This is a huge category that covers everything from the company car all the way to heavy machinery on a factory floor. And this gives you a sense of just how diverse these classes can be. Class 8 is a pretty broad catch-all for general equipment, and it has a 20% rate. That's your desks, your furniture, your photocopiers. Class 10, at a faster 30%, covers most cars and trucks. For more specialized, heavy-duty machinery like bulldozers, there's Class 38, also at 30%. And believe it or not, even the parking lot and sidewalks have their own category, Class 17, which depreciates at a slower 8% rate. This brings us to a very, very common question in tax planning. What happens when a business buys a more expensive car? To prevent massive write-offs on what it considers to be luxury vehicles, the government has created a special set of rules just for this situation. And the solution is a special category, Class 10.1. Now, it shares the same 30% rate as regular Class 10 vehicles, but that's where the similarities end. The rules are totally different. First, the cost you can claim CCA on is capped at $38,000. Second, each expensive vehicle has to be tracked separately in its own class. And finally, and this is crucial, when you sell a Class 10.1 vehicle, the usual rules of recapture and terminal loss simply do not apply. So let's just walk through that one more time. First, even if you pay, say, $70,000 for a car, your CCA calculation can only start from a maximum of $38,000. Second, that car is tracked all on its own. Third, when you eventually sell it, you don't worry about recapture or terminal loss on your CCA schedule. And fourth, here's a unique little quirk. In the year you sell the vehicle, you still get to claim half of the normal CCA for that year. Okay, let's shift our focus from the physical assets to the digital ones. The tools that really power a modern business are often in its computers and its networks, and the tax system has definitely evolved to reflect this, offering some very aggressive write-offs. The rates here are designed to be aggressive. It's a clear policy choice to encourage technology adoption. Just look at Class 12, a 100% write-off in the first year for things like application software, website development costs, and even small tools under $500. For the computer hardware itself, Class 50 offers a very rapid 55% rate, and the digital backbone, your data network equipment, falls into Class 46 at 30%. So the key point to really grasp here is the difference between system software and application software. The operating system that makes the computer run, like Windows or Mac OS, that's considered part of the computer hardware itself and goes into Class 50. But the software you install to do things, like Microsoft Office or Adobe Photoshop, that's considered application software and gets that fantastic 100% write-off in Class 12. Now, we're going to move into the realm of assets that you can't physically touch, but that can be incredibly valuable to a business. This includes things like intellectual property, brand reputation, and special rights established through contracts. And in this area, we see a shift in how CCA is calculated. For some of these assets, like improvements you make to a property you're leasing, that's Class 13, we use a straight-line method. We spread the cost evenly over the asset's life. This is different from the declining balance percentage method we've been using so far. Then, for other intangibles like goodwill or trademarks in the very important Class 14.1, we go back to a declining balance rate, this time at 5%. Now, here's an important transitional detail. Before 2017, assets like goodwill were handled under a totally different system. When the government created the new Class 14.1, it built in a special rule for these older assets, giving them a slightly higher CCA rate of 7% until the year 2027, just to help ease the transition. All right, let's wrap this up with some of the most powerful and timely rules in the entire CCA system, the enhanced rates. These are temporary measures, but they are designed to dramatically accelerate business investment in key areas, and they can be absolute game changers. For certain classes of assets, the government has basically suspended the normal CCA rules. Instead, it's allowing businesses to deduct the entire cost in the year of purchase. This is a massive cash flow advantage. It's essentially an immediate tax shield for the full amount of the investment. This chart really brings the impact to life. Under normal rules, a new electric vehicle would only get a 15% deduction in its first year because of the half-year rule. But with these enhanced incentives, that first-year deduction skyrockets to 75%. And for some tech equipment, it can be a full 100% write-off in year one. The difference is just enormous. So who gets to benefit from this? Well, the policy is very clearly targeted. It's designed to boost investment in clean energy, to help modernize Canada's manufacturing sector, to speed up the adoption of electric vehicles, and to upgrade the country's digital infrastructure. You can see the strategic priorities reflected right there in the tax code. But, and this is the most critical part, these incentives will not last forever. The clock is ticking. The enhanced rates for clean energy, manufacturing, and EVs are currently set to phase out before 2026, with the big tech write-offs ending before 2027. After that, we're scheduled to go back to the old rules. This creates a very clear and very urgent window of opportunity for businesses. So this really is the key takeaway. Understanding CCA isn't just an accounting exercise for compliance. It's about strategy. A deep knowledge of these classes, rates, and special rules allows a business to time its purchases, to manage its cash flow, and ultimately to lower its tax bill, freeing up capital that can be reinvested for growth. And that leaves us with a final thought to consider. The CCA system is always evolving to reflect economic priorities. So, as we push further into a greener and more digital future, what new types of assets will need their own class? Could we see special rates for AI infrastructure, or maybe for carbon capture technology? It's definitely a space worth watching. Thank you for joining me.